Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Scott Nations, president of Nations Indexes, to discuss Nasdaq-100 performance, trends in Nasdaq-100 Volatility Index, and also get his insight into 2022. Scott, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much, Jill.
Yeah, and Scott, quite the reversal of fortune for some of the stocks in the Nasdaq-100 index that we're seeing.
Yeah, it's a really tough day. It's been a pretty tough month actually recently. You know, the names in the Nasdaq-100, Nasdaq Composite had done so well for a while, so much better than the broad market, and now we're feeling the pain. Down well over 200 points right now, down more than 1%. So that's a little bit to be expected. I think when people get worried, they're going to aim for the highest valuation names, and those are some of the technology stocks.
Right, which is interesting because to your point, the work from home stocks, I would even call them the work from anywhere stocks, really did prevail over the past 18 months. And now that we're seeing the reemergence of COVID variants, it kind of is a head scratcher, unless the only factor outside of valuation is there. But it seems as if we're going to have to contend with a more restrictive lifestyle, at least for the next couple of months or as we get through the holidays.
I think you're absolutely right, and that's really disappointing for people. I think people were really ready to bust out, and now they're not so certain that they're able to, or that would really be wise. At the same time that winter's coming in places like Chicago, so those of us who have cabin fever and would love to bust out when we get the opportunity are really disappointed right now. And we also know that unfortunately inflation is a problem. So if you compare those two, then I don't know which one is going to be more important. Maybe inflation, because inflation is certainly not transitory.
Right. And then, Scott, as we look into 2022, what are some of your thoughts there? It doesn't sound like inflation is really going to be tampered, and we're really going to have to contend with that and interest rates, irrespective of what happens with the virus.
It really seems like the Federal Reserve is behind the curve on this. They said that while they're going to reduce the amount, they're going to taper the amount of accommodation between now and March. We're still going to be buying bonds. They're still going to be buying bonds as an echo of quantitative easing until March. Jill, what does that mean? That means that the only way that they can raise in the first half of next year is to raise in May. That's really the first Fed meeting that they're going to have an opportunity to raise at. It also means that from May until the end of the year, they're going to raise. At least if we get 3 raises, that means that they're going to raise it every other meeting. So what happens if inflation ends up being even worse than we see right now, or if we get the full employment? I think we're already there, but let's say that unemployment gets to say 3.5%. Then we're going to be in a situation where the Fed may want to raise 4 times next year. That means that at some point they're going to have to raise it back-to-back meetings, and that's really, really tough for the stock market when we see the Fed raising it back-to-back meetings. So I think the Fed's a little bit behind the curve, and if they scamper to catch up, then it's going to be really tough for the stock market.
Right. And you know what else I think it is, Scott? Outside of the Nasdaq-100, you can even argue the S&P 500, there was a concentration of just a handful of stocks that really were moving the averages, and perhaps under the surface, things weren't quite as good as those 5 to 10 stocks might have suggested if you just isolated that and looked at the major averages. That's
right. If you look at the broad market, a surprising number of stocks are more than 20% from their recent highs. You're absolutely right. The biggest names, the ones that are really carrying the water for the indexes, have done pretty well, and they've stood up pretty well. But that's probably distorted the situation a little bit with so many names relatively far from their recent highs. That indicates that the broad market is not as healthy as the indexes would lead you to believe, even though we're just a few percentage points from all-time highs, again, for those indexes.
Right. So as an investor, let's say you have a heavy Nasdaq-100 technology-driven portfolio. How would you position yourself going into 2022?
Boy, it's going to be really tough. I think that these names are going to be targeted because they have really high valuations. So what could you do? Well, we've talked before about buying put spreads. You can do that using NDX options or by using Q options. The problem with that, Jill, is that options are relatively expensive right now because of everything we've seen. And so you're paying more than a little bit for the insurance. That's to be expected. Insurance is something you have to buy when you can, not when you have to. If your house is on fire, it's a little late to be buying insurance. So you could buy insurance Again, it's going to be a little bit expensive. If it helps you sleep at night, though, and keeps you from making other mistakes, then buying put spreads as protection is a pretty good way to get some protection. Another way to do this, Jill, would be potentially to buy VOLQ futures that trade at the CME. The ticker symbol for the futures is VLQ. We know that implied volatility moves inversely to stock prices. We see VLQ up a fair amount today. So that's another way that you could hedge a portfolio, and that is buy implied volatility futures.
All right. One thing for sure is we will see you in January 2022. Scott, great to have you as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.